All right. Hello and welcome to Market Shares. I'm your host, Tony Blodgett. And today I'm going to talk a little bit about what's going on in the mortgage interest rate market. Just this week, the Federal Reserve came out and they raised the benchmark overnight cost of funds by 75 basis points. We're going to talk about that and was it the right move? The Fed also came out and he said in his comments after the policy was announced that, we understand the pain that is brought on to all American households because of inflation, and it's their commitment to get inflation back down to their benchmark 2% rate. Now, we know that this is not going to happen really quickly, but that is what they are still committed to. They have also, the Fed has revised down their growth projections. They have revised up their unemployment expectations, and they have revised up the short-term inflation expectations. You guys, all of that tells to me that that's all recessionary. Matter of fact, I think that we should be, assuming at this point that essentially we're in a recession. It'll be interesting to see where GDP comes out for the second quarter. I do believe the Fed said that they expect GDP for 2022 to be around 2 to 3%. So obviously, if that's what they're thinking, and we know it was negative in the first quarter, they have to assume there's some positive numbers coming. But I'll be surprised by that, to be honest with you. But whether it's today or whether it's a few months into the future, the likelihood is we're going to see a recession. I did a whole show about that. I don't think recession is a negative thing. Matter of fact, my friend Dan Keller posted something on Facebook the other day. He said, and every time you hear recession, just think opportunity. Instead of fear, think opportunity, because there definitely will be opportunities in this market for many people who can capitalize on it. So let's go back and talk about the Fed's decision. So here's kind of how I saw it play out is the Fed last month, made it pretty clear that, or at the last meeting, that they weren't going to have to be as aggressive as kind of previously indicated. So the market actually liked that at the time. But as we got closer and closer to this meeting, it became apparent, especially with the 8.6 CPI number we had last week before this announcement came out, the Fed had to do something more than just the 50 basis points that had been anticipated. So it seems to me like they kind of let a little whisper out into the marketplace. They kind of leaked it, if you will, to expect 75 basis points, and that's exactly where they hit. I think it was a perfect move because the market saw this as the Fed kind of correcting course right before the meeting. And, instead of just going with what the market was expecting, they did a little bit more, but they softened that blow a little bit by making sure that the market knew that that's what they were thinking. A lot of people that I follow and that I talk to go, man, they should have just went 100 basis points. I mean, this inflation thing really needs to get under control. I personally believe if they would have went 100 basis points, it would have spooked at least the equities markets, and we could have seen some loss there. And instead, we've seen kind of gains across the board. I think it was the right move, and I really like the Fed's comments after the policy decision. He made it pretty clear that we not only know what needs to happen, we have the fortitude to follow through with making sure inflation gets under control. So here's what you can expect. Look, mortgage interest rates actually got better today. Like, I don't know if people realize the correlation here, but when the Fed raises rates, and they do it with the intent of fighting inflation, that actually helps mortgage interest rates get better. And it's counterintuitive. Matter of fact, you won't watch a news article this week or watch a news program on CNBC or one of these, TV stations. They're all going to kind of make it sound like the Fed just made it more expensive to buy a home. And the reality is mortgage rates actually got better. And the reason why that happens, just in a brief, kind of overview, if you don't understand the way that it works, is because when you purchase a mortgage-backed security at a certain coupon, let's say it's a 4% coupon, well, that means that there's a certain yield that's coming to you on that 30-year mortgage. And that yield doesn't change for the life that you own that bond. It's a fixed return on your investment, if you will. And so what happens is as inflation goes up, the amount of goods, let's say, that you could purchase for that fixed amount of return. So I invest, $100,000, I get 4% return on my money. Well, that number doesn't change. The fixed number that I'm receiving doesn't change. But if inflation goes up and those dollars are worth less, it's almost like my investment is shrinking over time because inflation is going up. And so in a simple way, that's what's going on right now. So with the Fed saying, hey, we're going to make sure inflation doesn't keep going up because we understand the pain that it brings upon everybody, the pain that it causes to your fixed amount of return on your mortgage-backed security or 10-year treasury bond or whatever it is that you're investing in. Since they're fighting that, it's going to prop up the prices because there's going to be less erosion of that value. I know it's complicated and counterintuitive, but it is ultimately a good thing. And look, here's the, I guess, maybe bad news or just the facts of the matter is that, inflation hasn't peaked yet. And so we're still going to probably see inflation numbers that come out during the summer, and they're going to replace the inflation numbers we saw last summer, right? It's like a rolling 12 months. And so when you look at that total CPI number, it's probably going to creep up before it goes back down. And the Feds are going to have to continue their monetary policy of continuing to increase interest rates and aggressively, unwind their balance sheet. And just another thing there, when the Fed says they're going to unwind their balance sheet, you got to realize that what they were doing over the last 2 years, really since March of 2020, is they were purchasing mortgage-backed securities. They were purchasing 10-year treasuries. And so what happens with anything, there's a supply and demand component. And so when the Fed is purchasing mortgage-backed securities, they're essentially creating demand that doesn't really exist because they're the only ones buying it, but they're buying enough of it that that demand drives up the price. And when the price goes up, the yield goes down, which is why rates have been down. Now, if the Fed goes the opposite way and they start unwinding their balance sheet, what they're doing is they're creating a greater supply. Now, no longer are they not a buyer. Now they're a seller. And they're selling into a highly inflationary market. So demand's going to be down just because of inflation, generally speaking, on bonds or mortgage-backed securities. And now we have the Fed creating an oversupply of those. Well, what happens when there's an oversupply of something? Well, the price goes down and the yield is inverse of the price. So if the price goes down, then the yield is going to go up. And so that in and of itself should create some more demand, but it can be very tumultuous during that process. So I hope that makes a little bit of sense, but the Fed is going to keep raising interest rates. We know that. They've made that commitment, and it's what they need to do to get inflation under control. We know they're going to continue to aggressively unwind their balance sheet, and so we know that that's going to happen as well, and that's going to create a larger supply of both mortgage-backed securities and 10-year treasuries, and that larger supply is going to drive down the prices, and it's going to increase the yield. So that means interest rates will probably continue to go up in the short term. I guess that's the answer, is that although today was a relief rally for mortgage-backed securities, I think the long-term trend is we still continue to see mortgage rates go up a little bit throughout the summer. Okay, so what does this mean for you as a consumer, as a loan officer, or as a real estate professional? Well, here's what it means, is that people are fearful. People are afraid. People don't like to hear that mortgage rates are going to keep going up. People, start seeing a number of price reductions in the real estate market. And these things really do have the ability for people to go, oh, this is really unstable. I think this market's going to crash. And that tends to be where people go immediately, especially people who are kind of from my vintage, my age, which we lived through the last, big crash in the real estate market. And so we immediately start seeing some, we're used to things just skyrocketing straight up, right? We saw double-digit appreciation the last couple of years, and all of a sudden we see a little bit of a slowdown, and we're like, oh, this thing's going to crash. Well, here's what I can tell you. At least my expert opinion is that I do not believe the housing market is going to crash. I believe that it's going to probably correct, and in certain areas, it may even come down a bit. But the question is, down from where? Because if we had like 23 to 30% appreciation in 2020 in some markets, and then 20%, 18%, 15% appreciation in 2021, like what are we going back to? We're only going back to probably about a year ago as far as values go. So, but look, it's up to us to educate people about this. We have to explain to homeowners what's actually going on. We have to, talk to, the real estate agents out there who don't understand the mortgage market and help them understand what's going on and keep people inspired. Because I'll tell you what hasn't changed through all this. What hasn't changed is there's this whole group of people that are around 30 years old to 35 years old called millennials, and they're the largest group since the baby boomers, right? And so we still have this huge cohort of people that are turning the age that is the prime age to start a family, buy a house, etc. And the other thing that hasn't changed is we didn't just all of a sudden come up with a whole bunch of new supply of houses. So the same kind of economic situation in housing that created this boom. Now, granted, it was exacerbated by COVID and by super low interest rates, but the demographics haven't changed. Way too many people, not enough homes. So we're in this period where the good news is if you're looking for a home, you're going to have more options. There's going to be less bidding wars. You're not going to have to settle for just whatever you could get because you've made 15 different offers on different houses, and you'll just, any Cracker Jack box that comes available, you're like, we got to buy this or we're never going to get a house. You don't have to do that right now in this market. So don't be fearful, because long-term, purchasing a home is still a really great investment. And I'll tell you this, personal experience, I purchased a couple homes, actually, investment homes in 2006 and 2007. I know, it was brilliant on my part. But look, it was the heyday. I thought I was going to be like this huge real estate mogul or something, right? So I bought a number of houses in 06 and 07. And when the crash hit, I owned 7 single-family residences. And I was scared. I thought I was going to go broke. A lot of people did, go broke or lost their home to foreclosure. Luckily, I was able to hold on to these homes. And it wasn't too many years later that I was able to start selling those homes off one at a time. I probably should have kept them, by the way, but I was tired of being a landlord. That's a whole nother story. Probably should have kept them. But the moral of the story is I didn't lose money on any of those houses, and I bought them at the absolute peak of the market. And that was a recession that was driven by home values going down and toxic mortgages being given out and mortgages being given to people that didn't even qualify for home loans. We have none of that existing today. So I guess my message overall here is don't be fearful about what's going on in the market. Yes, there's going to be a pullback. We've been cruising down the freeway at 100 miles an hour and we just came to a stop. That means we're going 100 miles an hour less than we were, but it doesn't mean that we're going backwards. And even if we do go backwards a little bit, the silver lining is there's more options to choose from for your buyers. And for you, if you're a homeowner, like there's better options. You can get the house that you're going to love and your family's going to be in for a long time. And you're probably going to be able to refinance that house at some point in the near future. Because the other thing that we do know is the Fed is going to fight inflation, even if it means putting the economy into a recession. And there's nothing about lower growth projections, higher unemployment, and continued inflation pressures that tell me that we're not going to go into a recession. And we know that what happens in recessions is that interest rates are going to have to come back down. So it's kind of funny that we're sitting here having a conversation about the Fed raising rates, already knowing that this is going to return and go back the other direction. I promise you, you're going to wish that you had purchased a home when they were available, because the demographics aren't going to change for at least the next few years. And by the time things start to maybe shift there, we're going to be back to what I would say a more normalized inflation environment. Interest rates will be back down because rates cannot stay at these levels. This is a reaction to what's going on with inflation 100%, which was driven by the decisions that were made to keep the economy alive during COVID. So if you can kind of see what's happened here and just think about getting through kind of the tailwind that we're dealing with from the COVID decisions and think about a more normalized market, interest rates probably not as low as they were, but not nearly as high as they are today. The demand is still there for housing. Look, no reason to be fearful. So anyways, I hope that all makes sense. I know it's a lot of confusing stuff, and it's maybe not as fun of a conversation as the ones where I have a friend in here talking about the market or about, their careers or whatever. I love doing the interviews, but I thought this was an important message to get out in light of the Fed's raising interest rates, because many of you who watch this, who are in the mortgage business, know exactly what I'm talking about. But I think there's others out there who are really confused by all this, and I hope that today's show helped bring a little bit of clarity about how you should be thinking about the market today. So with that, you guys, if you like this content, please like and subscribe and share it with a friend or a coworker or someone that you think might also enjoy it. We're just getting started here on the basis on market shares. We are intending to grow this out and continue to bring great interviews to you from awesome people all around the country and up to the minute relevant market data as well. So please subscribe so you don't miss any of those future videos. And until next time, thank you so much. I've been Tony Blodgett. It's been a pleasure being with you today. Take care.